All right, everybody. Ladies and gentlemen, welcome to us here at Nadex. My name is Philip, and I will be your presenter for today's webinar. Today, it's trading the global markets through binary options. One big hands-on case study. What is it that the markets are telling us, and how can we trade those potential setups in both directions using those great Nadex contracts? If you look at your webinar interface, as usual, you can see that small questions box. First, I would like to give you guys, I would like you guys to give me a short feedback here that you guys can hear me well, that you can actually see the screens changing. Let's move over here to the next slide already. And please, if you happen to have any questions through the course of this webinar, let me know. I want those sessions to be interactive. Obviously, I know what I'm telling you, but I want you guys to understand what I'm seeing on those charts and at least what are my thoughts approaching those markets. Please ask questions. I feel this is a vital part of the learning experience, and so you're not interrupting my flow. This is not some kind of disturbance or annoyance. No, I'm really looking forward to that interaction. So please, once again, don't be shy and make use of that small questions box. That being said, today's webinar is scheduled to run for around about something in between 45 minutes, 60 minutes. We will see how much questions you guys have and we will finish there with that. And of course, you already see those first risk disclaimers here on the screen. Please take a moment of your time, read through them carefully. I have to make you aware of them, so please make sure you are comfortable with them before continuing with the webinar. Essentially, this says that trading, of course, involves risk, and you should understand those risks and the risk associated with the instruments you are using before you are getting active in the market. As neither Trade with Precision nor myself are investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only. Especially true for the live part of this webinar. We will be looking at the markets together. I want to show you guys what I see on those charts and what are my thoughts about approaching this type of market environment and how this could be tradable. But I don't have a crystal ball. I don't know what's coming next. I know how I can make money in the market, and this is by having more potentially profitable trades in my hands than losing trades. And the second component to a positive expectancy is that the winning trades, potentially profitable trades, are larger. They give me more potential gains than the losses that I will have to pay on the losing trades. Winning more often than losing and winning bigger. Those are the two components to a positive expectancy. And this also illustrates this idea why it's never about the next trade. I don't care about the outcome of the next trade. I just care about placing flawless trades, only the best trading opportunities, only the best setups, because then I know over a large sample set of trades, if I do that 100 times, 1,000 times, 10,000 times, I know due to statistics, law of large numbers, I should be able to get out ahead. And this is how you make money in the market. It's never about the next trade. It's never shooting for 100% only winning trades. Won't happen only in fairy tales. So please make sure you're okay with all this before continuing with the webinar. And that being said, let's have a look at the Nadex risk warning as well. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicated for future results. Nadex contracts are based on underlying asset classes, including forex, stock index futures, commodity futures, cryptocurrencies, and economic events. Trading can be volatile, and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. Let's have a look at today's agenda. Approaching those market environments, obviously there are many different ways to trade those markets, independent of what kind of market you want to trade. But if you want to trade those markets using binary options, those binary options present us here at Nadex with a great set of features, of attributes that make it very attractive to trade those markets using binaries. We want to focus on those very briefly, but most of all, we want to see how can we trade those instruments, which instrument to actually pick, spread pricing and selecting the right contract, practical binary trading scenarios, and of course, all this done live in the markets in the here and now, or as we like to call it, trading on the right side of the chart. No hindsight, no hidden information. So what are the advantages of trading binary options? What are binary options? And this is really just a very high-level overview here. We have dedicated webinars explaining and illustrating the ideas behind both spreads and binaries and the new brackets. It's all about here getting the high-level picture and then moving on, seeing them in action. So what are binary options? Binary options are straightforward capped risk derivatives. They are simply, they are based on simple yes-no proposition. Binary contract always has a strike price, and the only question that you have to answer yourself at the expiry date of that option, will the price of the underlying market be above the strike price, yes or no? And that's it, simple as that. It's not how deep in the money should the underlying market be, which means how far beyond the strike price is the underlying market trading. It doesn't matter. If it's in the money, price is trading above the strike price, it's a yes decision, it's a $100 payout on that contract. If it's a no decision, which means the price is trading below or at the strike price, it's a $0 payout. Simple as that. And that way, they do offer us an intuitive way to trade the financial markets with relatively low collateral. You don't have to put on a huge deposit, a huge margin to trade those contracts. If the payout is a maximum of $100, yeah, you can trade this market with a minimum of quite a little, but one contract can only cost up to $100. So you can see it's much easier to get involved in those markets than, for example, to trade futures or to trade stocks. Don't even get me started here with stocks and the pattern day trading rule. All this gone for good here, looking at those Nadex contracts. They allow us to be active traders also with pretty much a small account size. And we can trade many different markets, international, global markets, using that one single account, another big advantage here. So I can't stress this enough. We trade with strictly defined risk. This is a complete game changer if you come from futures, if you come from stocks, where you see the market suddenly gapping against you big time. Yes, you might have your stop loss in place. However, the market just gapped beyond that stop loss, then guess what? You're in the world of pain. Yes, you will be stopped out of that position, but obviously the loss that you took on that trade was much larger than anticipated. Can't happen here with Nadex contracts. You know your maximum risk up front. You have a strictly defined risk exposure on those trades. Absolutely unique and outstanding. We already mentioned the low collateral required to trade those markets. You will have opportunities in volatile and in flat markets alike. Nice thing with options is they do give you options, pun intended. If the market isn't going anywhere, well, you can just sell time value at that state and just wait for the market to not do anything and for those options that you just sold to expire worthless, for example. And many different expiry cycles, multiple daily trading opportunities, multiple expiry cycles within a day, but also, of course, looking at weekly cycles as well, giving us more time to analyze the markets and for larger moves in the markets to actually start to play out and show themselves. So let's look at the markets right now and see what's going on there. And then the big idea is, how can we trade those markets using Nadex contracts? And right now, I want to focus really big time here on the S&P 500. What has the market been doing? Let's zoom out. We had been in this beautiful long uptrend, and it was really a large, long uptrend here all the time. Then the market, it got noisy back here. Prices dropped quite steeply, and then the rally resumed. But please note, if you compare that high to that high here, we start to see, yeah, the strength just wasn't there any longer. We start to see that divergence is showing up here in both MACD and RSI. So that's the first warning sign here that the big picture might not be that beautiful and that strong. When the sell-off finally came, the sell-off took multiple stages and took us down to this low here. But since then, the market has started to rally again and to push higher. 200 period moving average. And what I would like to see is my so-called fanning pattern. I want to see that the 10 is clearly above the 20, clearly above the 50. I can just eyeball this chart here in this area, and I know, yeah, at least short term on the daily chart, some buying momentum must have been there. Otherwise, I wouldn't get that structure in those moving averages here. Obviously, the 200 is always lagging behind. Back in the day, you saw, yeah, that's the structure that we're shooting for here, all the way. This is the most perfect period here of them all. 10 above the 20, above the 50, above the 200. This is what I'm looking for. Here takes a little bit more time. Another tool that I like to use very frequently with my analysis are, and I like to call them simple, stupid horizontal lines, because they are just that. They are really just horizontal lines. And I just placed that line here somewhere on the chart. Doesn't matter where, because now I can just pick it and drag it where I need it. And one thing that I like to show you guys here is, obviously, we are trading right now at this 2,800 level. While this is not the perfect level to draw this line, it's a big round number. I'm pretty sure that most of the mainstream media in the United States right now will tell you guys, oh, the Dow is back at, sorry, the S&P 500 is back at the 2,800 level again. So the markets crash has been canceled, nothing happening, markets are strong. Big round number. People are looking at those levels. People are paying attention to those levels. People have orders waiting around those levels. This is why those big round numbers are interesting for us traders, because obviously what we see on that chart is just the result of people acting and trading in the markets. So this is not just some magical price generated from who knows what. No, it's the observable results of people trading in the markets. And if people trade in the markets and if people pay attention to big round numbers, sure enough, price will act around those big round numbers accordingly. However, what we can do with our levels is also just, again, I place it somewhere and I grab it and drag it somewhere. And I hope you can see, guys, here in this area, we had 3 points, 2 points, but pretty much precise levels here. Here, precise interactions with this level again. Let's zoom out, 820 level. And since then, price has started to pull back. The usual pullback that we like to see in a good, strong, healthy trend is a pullback to what we like to call price equilibrium levels. Pullback to the 10 and 20 period moving average. In an uptrend, the 2 moving averages here form what we like to call the moving average buy zone. And you can see price pushes higher and it has to pause a little bit. It has to catch its breath. It's pulling back. Where does it pull back to? Price equilibrium levels, stays there for a wee bit and then continues higher. Pulls back again. Where does it pull back to? Right in the zone. Now, just recently, as price was approaching this 2,800 level here, and you started to see price didn't really break through. Indecisive candle here setting up, bearish candle setting up here, price action just below this level. And finally, price was able to break through, but even after this breakthrough candle here, the next candle, very weak, very, yeah, it's not really going anywhere. If this was a leap of faith, you would like to see huge candles and the markets, the bulls just stomping away. Didn't happen here. Small candle, just crouching below the level that we just have now identified. Next candle, bearish candle, price started to come lower again. Once again, if we compare the high that we made here with the high that we made here, we start to see in MACD once again divergence setting up and another divergence here within RSI. All the techniques that I use here, are they perfect? Do they give me perfect results all the time? Absolutely not, far from it. But what they allow me to do is they allow me to stack the odds in my favor. I'm able to identify small advantages, and I want to gather and sum up those small advantages, because I like to use my picture here of a crime scene. If I'm the inspector and I'm investigating and I interrogate 5 different witnesses, and those 5 different witnesses tell me 5 completely different stories, I don't really have a clue what has been going on here. However, if those 5 witnesses describe the same crime, describe the same potential offender, I know what I'm looking for. Same thing here with technical analysis. I try to identify those small clues, those small hints. And if all hints that I can identify start to point in the same direction, I might have a potential trading opportunity on my hands. This takes part of this really is trying to have more potentially profitable trades than losing trades on my hand. By identifying small advantages, I'm able to do that. Coming back to this chart, what's going on here and what is the next idea? Well, the pullback that we got took us way beyond our moving average buy zone. It was a deep pullback, took us almost back to the 50-period moving average here. And now price is trying to rally again. Bullish candle here, small indecisive candle next, and then a strong bullish candle. And now you might assume, yeah, there's the momentum, there's the power, and here the market just will fly through the 2,800 and run about 2,820 level. But guess what? It doesn't seem to be happening here right now, because right now it just looks that price is sitting once again just below the 2,800 level. And the deep pullback, we lost momentum here, further divergence setting up in the market. And by the way, we also see a resistance 1 pivot point setting up here perfectly on top of this 2,800 level. Philip, that's all very nice, that what you described here, but come on, how can we trade this? The question now is, what is your expectation? I can make 2 cases here, and I would like to illustrate how I would go about potentially trading those 2 potential cases. But once again, it's just what I'm seeing here. I don't recommend taking those trades by any means. It's just, I want to show you that complete process chain and give you guys the opportunity to ask questions about it. So scenario number 1 that might happen is that price might be starting to push higher. Finally, we get the breakthrough through 2,800, but due to the loss of momentum here, we might be shooting for 20 additional points in the S&P 500, but then we might start to encounter resistance there. One possible scenario, as good as any other one. But I hope you can see how I arrived at that idea that, yeah, maybe we will finally get the breakthrough, but yeah, maybe not that strong again. I could be completely wrong. The market could start to just move sideways now. It could start to fall apart. It could start to finally crash through all those levels and shoot for infinity and beyond. I don't know. But I have to come up with a scenario that makes sense for my potential trading opportunities. So first potential traders, all right, I'm speculating that we might get a push to 2,820 level. And how could I potentially cash in on that move? Will that move be? Could be tomorrow, could happen never. However, I want to give this trade a little bit of good idea, a little bit of good time to develop itself and see what's, I want to give this trade some time to play out. By this analysis that I now shared, it doesn't make sense for me to look at an option that would expire within the next hour. If I want to trade based on the daily chart, I very often like to focus on the weekly contracts available. And if I move over here to the Nadex platform, I now have already opened the S&P 500 weekly options. And the question is, which of those contracts could I consider to trade right now? And once again, this is just educational purpose, not a recommendation. A random guy on the internet telling you what he's thinking about a market should never be good enough for you to put your hard-earned money on the line. You must own that trade. You must, for yourself, come to the conclusion that this is the trade that you want to put on. So I'm looking here at the 2,800 level, where we are pretty much trading right now, just 5 points below it, and 2,820. Personally, I would be looking here at the 2,812 and 2,824, each time 0.5 strike prices. Let's talk about money for a moment here. My account value right now is sitting at $22,978. So round about $23,000. It's a demo account, and if you haven't one, I highly suggest that that you get one, familiarize yourself with the platform, and just get a feeling for everything. So easy to do, costs you nothing at all. By all means, just go for it. So my rule of thumb when I trade is I want to risk about 1% of my account on this trade, on this potential setup. So this means I'm willing to risk right now round about $220 on that trade, because 1% of those $23,000, something like $220, $230. That's the first number I have to keep in mind of. Next thing is, I could split between those potential two trades here, potential two contracts here. So if I'm shooting for a risk of $230 total, and I want to split, I want to be a little bit more aggressive and a little bit less aggressive. So if I want to trade two different strike prices here, I can split that trade into two trades, each risking $115. So the idea is, if I buy this 2,812 contract here, I click on offer, and then the deal ticket opens up. Now, it's very simple. I have never seen a platform that makes it so simple for me to stick with perfect risk exposure and perfect position sizing built right in. Because now I just say, okay, I want to buy one contract here. And here it does immediately show me my maximum loss is $37.25. Now I can buy as many contracts until this number 149 is larger than the 115 that I'm shooting for. So I could consider buying 3 contracts here. I just bought 3 of those contracts at a price. Let me just write this down. 3 at a price of 37. Next thing that I could do is I could be looking at buying a contract for the next higher strike price. I can buy this contract right now for a price of around about 1925, 1930. How many contracts can I buy? Well, once again, I can just dial this number up until my maximum loss. And this is spot on. I can't lose more than that money on that trade. So a little bit too large. So let's go back to 5 contracts here. Let's just buy those 5 contracts. Place order. And the order is live. So I just bought 5 contracts at a price of 20. Now, at that stage, I could just say, okay, it's fire and forget. With half of my position size, I'm speculating that at expiry, which happens to be in 3 days, time left, the market will be trading both above 2,812, which means $300 payout on the first contract. And if it's trading above 2,824.50, if it makes it to this level and beyond, should be good enough for me to actually get the full payout there. But I don't have to do this fire and forget or hope and pray approach to trading, because I can manage that position actively. And one key component here is to keep in mind that if the underlying market is approaching and is trading around the strike price of a binary option, the price of that binary option should be very close to 50. That's just the way that those contracts are priced. And those of you with a background in plain vanilla option, you can think of the price of the binary option something like the delta of a conventional option. delta of a conventional call option. So if it's trading at the money, this option should have a delta of around about 50. If it's trading deep in the money, it should be approaching 100. If it's deep out of the money, it should be approaching 0. Never really getting there, but in this area. And this one thing that makes it so easy for me to do proper position and trade management is this basic idea. All right, if the market is trading around the strike price, price should be moving towards 50. All right, what does this mean for my trade management here? Well, I was able to buy this market here for 37. Now, sorry, 36 it says. All right, so what I like to do is I want to get at least a 1-to-1 profit target on my trades. So what I can do now is I can just click on this contract here. That's the 3 that I just bought. And I'm looking to sell 2 of those contracts, but I don't want to sell those contracts right now, but rather I bought them for 36. So I want to make what I risk on those contracts. So per one contract, I'm risking 36. If I sell 2 contracts at 2 times 36, which should be 72, I'm locking already in a lot of profit on those 2 trades, on those 2 contracts. Essentially, I'm locking in more potential profit on those 2 if price really starts to push higher and trade around 72, which it should do if price is trading and approaching this level here. Pricing close to 72 should be doable if that scenario actually happens. And so I'm scaling out of my position. I'm closing 2 contracts here at a price of 72. I'm taking risk off the table. I'm already locking in here a profit of 144. So let's just place the order, and it's a limit order, and it just sits there. And if price starts to push higher and hit that level, and the price is sitting at 72 of those contracts, the order will be filled, and I've scaled out of my position. And I can do the same thing now with the way more aggressive trade. That trade costed me here, that contract just costed me 20 bucks. Why? Because it's deeper out of the money. Price has to travel an additional 12 points just to be trading at the strike price. Deeper out of the money, price has to work more, price has to travel more, and for that very reason, obviously the contract is cheaper. Same logic applies. I bought 5 contracts here, each for $20. All right, $20. So my risk per contract is $20. So if price moves from $20 to $40, and I close out 3 of my 5 contracts, I'm already locking in profits, and I don't really care at that stage where the market will close, where those contracts will expire, because at that stage, if this contract actually is trading at 40, I've already locked in some profits here. I can't really lose any longer if that scenario happens. Guys, does this scaling out make sense? Does it make sense why I do go for twice the price here? I want to close half or a little bit more than half of the position here. This is some, a little bit advanced trade management, but not really so sophisticated. And those Nadex contracts are just haven't made to do that style of trading. They just perfectly allow me to do that kind of trade management. And pretty much once the trade is live, you see I enter all those trades and all those orders right now, here and there, and I don't have to watch the markets all the time. Last week, I just got in the middle of the night, I just got a beep. Oh, by the way, your S&P position hit the first and second profit targets. Positions have been closed. Very nice. And yeah, I was asleep. I saw it in the morning. I don't have to watch the markets all the time. I can actively manage my position up front. Very powerful feature. So I want to close 3 of those 5 contracts at a price of 40. And what I can do now is that I also think, all right, I have 2 more contracts on here, so why not close an additional contract? If price keeps on shooting higher and is even giving me a 2-to-1 on that trade, If the contract is trading at 60, I bought it for 20, then on this one contract, I'm already locking in $40 profit for a initial risk of $20. 2-to-1 reward to risk ratio. Two components, trying to win more often. This is what I use my technical analysis for. Second thing, I want to win bigger. I want to risk $1 or $100 for the opportunity to make more than $100. And this is how I do it here with this trade management, looking for my potential profit targets and scaling out. KM is asking, if the price goes through the ceiling of the contract, do you get the payout? Let's be precise here with the terminology. Ceiling is something which is within spreads. Here we're looking at binaries, but if I just assume you mean the strike price here. Absolutely. If price, again, let's be precise. We have to wait for this contract to expire. So everything I've done here so far really is in trade management while this trade might still be on. The contract still has about 3 more days left, and within anything can happen. And if price starts to push higher and those contracts are trading at my limit prices, those orders will be triggered and executed. I will not get the full payout if price trades at those strike prices or beyond. The full payout, automatic execution, only occurs at expiry. So when the life cycle of these contracts ends, then for the remaining parts of remaining contracts of my positions, then Nadex will look and see, all right, is it in the money? Is it trading above the strike price? If yes, that contract settles at $100, and only then does it settle at $100. So in between, while this contract is still live, prices will change, and if it's very deep in the money, price will approach asymptotically definitely the $100, but it won't get there. This dedicated payout only occurs at expiry. I hope that answers that question here. If not, please let me know. Thomas is asking another great question. What is the advantage of trading weekly rather than daily? I trade daily, and that's perfectly fine. The question is on which. Let me just quickly get back to the slide, to the charts here. We are looking here at a daily chart, and this means everything that I explained here. One candle represents 1 day. Do I think that it is likely for price today to push to this level? Could happen, yes. But honestly, with the weakness that I'm seeing here right now, not sure about it. However, if I'm going for the weekly contract, I have 3 more days, 3 more candles for price to actually move somewhere where I would like it to be. I just give that trade more time to work out, to play out for itself. However, if I was just looking here at a 50-minute chart, let's say, and I want to trade this and think, yeah, the market might be pushing for this level, and this is what I trade. That's my time frame. Absolutely, trading smaller time frames, smaller, faster expiry cycles makes perfect sense. So, Thomas, the question comes down to what is your expectation of a move, and how much time, how many candles would you like? You can just eyeball it. How many further candles would you like to see, and think that with the current speed of the market, that it's likely for price to hit those levels? And does this contract give you enough time for that move to actually occur? KM is following up with, so you can actually make more if executed before expiration, and then price is above the ceiling, you can make. No. The price range of a binary option always is between 0 and 100. It cannot occur that a binary option is priced beyond, that the price drops below 0 or is trading above 100. The binary option is always limited within this 0-100 range. So, okay, perfect. Thanks for that. And by the way, other webinars coming up explaining those instruments with more detail, and obviously lots of great videos and educational articles also on the Nadex website. So looking at those and getting started there. And again, play around with the demo account, getting a good grasp and feeling for everything doing there. Thelman, thank you very much for that one. I really appreciate the feedback. All right, guys. So coming back here to the daily chart. Any questions on that potential game plan that you just saw here for potential long trade? If you don't have any questions there, I would move on to the second scenario that could be happening. You've seen that there was some kind of divergence setting up here. You saw a deep pullback. You saw some additional weakness. You saw that this candle here might have a hard time to actually push through. Lots of good scenarios, lots of good cases to make that the market might be actually shooting lower again. So how could this be traded if you're more on a bearish side? Here on the same chart, the same market, if you would like to make more a bearish case. Just reading the questions, just a moment. All right, David is bringing up a very good point. It's going in the territory of trading psychology. Would love to do a dedicated session about trading psychology in the future. If you guys want to get a webinar on that, please let us know. More than happy to do it. David just said the real danger then is the urge to keep putting money in when you keep losing. You want to be strict with your position sizing, and you never ever want to throw good money after bad money. You had this idea what the market might be doing. You built your case, discussed everything, and you could explain logically with your rules, with your trading strategy, why you want to go in that direction. And that's the trade that you want to take. And on this trade, or this lottery ticket that you want to buy is worth to you, let's say 1% of your account, and that's it. That's the maximum exposure that you're willing to take on that trade. For me, it's really fire and forget. I do become frustrated if my trades don't work out. But fortunately, this idea of, oh, I'm just buying more, or I'm selling more if the market is rallying, I'm selling more. No. Risk exposure is absolutely crucial, critical for survival. You must make sure that you never ever risk more and throw good money after bad. Great point here, and thank you very much for that. David is bringing another point. There's a good chance this will go bearish. Just be ready to get out if it goes above the start of the first red candle. Perfectly fine also. You can have stop losses in place here. What I just did here with my profit targets, you can also do it just the other way around and use stop loss limit or stop loss orders here at Nadex as well. The nice thing is you don't have to do it. If I do the position sizing the way that I showed you guys, what is my maximum loss that I'm willing to take on that trade? There I have built in my 1% risk limiter. Therefore, I don't need stop loss orders. The beautiful thing about those binaries is, even if price pushes to the stop loss level, in every other, using any other instrument or using stop loss orders, I would have been stopped out. How many times have you seen it that the market just hits your stop loss level and then resumes in the original direction of the move that you anticipated? Those binaries have time value built in. They have 3 more days to work out. So if I would have used a traditional stop loss order, just say below the low of this candle here, if price briefly dips, futures, stocks, CFDs, anything, I would have been stopped out. With the binary, yes, the value of my binaries just dropped pretty close to 0, but that's fine. I have this built-in maximum risk, which I chose when I did my initial position sizing. And if the markets recover and rally, nice, I'm still in that trade. I haven't been stopped out, so there is no dedicated need for a stop loss order. But be absolutely adamant about your position sizing, never risking more than the initial amount that you were looking for. All right, so if you think the market might be going lower, How could this be traded? Well, if the market starts to fall apart, next thing, where are we trading right now? Very close to 2,800. And just to illustrate a point which I brought up before, 2,800 strike price. Where is this contract currently trading? 50 to 55. If it's trading at the money, price should be in close proximity to 50. All right, so what I could do is I could sell this contract here for a 1-to-1 reward to risk ratio. I'm getting 50 for a potential risk of 49.75, 1-to-1. Not awesome, but it's okay. I don't want to sell the 2,812 because here, let's just have a look at that. Let's just assume I was to sell one of those contracts. My maximum profit is $30.50. The maximum loss, however, is close to $70. So this is more than a 2-to-1, more a 1-to-2 reward to risk ratio. This is not what I want to do. I want to risk $1 in order to make potentially 1.5 or 1.7, 2, 3, $4. Risking $7 for the opportunity to make maybe $3, it's just not worth it. Remember, winning more often than losing and winning bigger. Those two things. And this is not winning bigger. This doesn't make any sense for me. There might be scenarios where this works perfectly fine, but not for my style of trading. So what I would anticipate is if price starts to drop down, here we have this small cluster of pivot points setting up here and 2,760. So this could be one potential target, and just eyeballing it, just let me try to draw this in here. Let's just pick retracements, go from this swing point low to this swing point high. And yeah, the 50% retracement is also sitting very nicely just on top of this 2,760 pivot cluster on top. So potential pullback target of 2,760, not that unlikely. Let's just put it that way. Will this happen? I don't know. Nobody knows. But I can set up a trade that could make sense if we get this pullback. So 2,764.5 is currently trading at 86 to 92. If I was to sell this contract here, I sold one of those contracts, I'm getting for a maximum loss of $13.50 for a maximum profit. If it settles, if the underlying market settles below or at the strike price, at expiry on Friday, $86.50. Way better than this risking $7 in order to make $3, if you ask me. Now, again, I want to split this trade. I want to be a little bit more aggressive and a little bit less aggressive. So let's be more aggressive here, less aggressive here. How much may I risk? I may risk $230. Splitting that up, I'm shooting once again for a risk of total risk here of what about $115. So I'm willing here now to sell. And I just dial this number up a little bit too large here. I'm looking at selling 8 contracts for a total risk of 108. And I'm just selling those contracts here. Same logic applies. I want to manage that position actively. So if price starts to drop, or I want to already start to take risk off the table. I sold for 86, which means it's a risk of $14. So 86 minus $14 gives me a target price of 71. So if price just drops to 72, sorry guys, just drops to 72, I have hit my 1-to-1 reward to risk ratio on that trade. And there I want to scale out. I want to take 2 of those contracts off, 4 of those contracts, half of my position off the table. I'm locking in profits. At that stage, if that price level is hit, there shouldn't be so much going on, and I shouldn't be able to lose any more on that trade. So put in this limit order, fire and forget. It's good till cancel, which just means that order sits there all the time until it either gets executed or the underlying market or the underlying contract expires. So 4 contracts actively managed here, and I can just continue to do the same thing. So I could go for another 2 contracts to scale out, for example. Let's just go for 2. What is my 2-to-1 target price here, reward to risk ratio? Well, I just have to deduct those 14 from the 72, and that should give me a price of around about 58. So 58, buying 2 contracts, scaling out further at a 2-to-1 reward to risk ratio on that trade. And the 2 remaining contracts, I could do a 3-to-1, or I could say, wait, with the remaining 2 contracts, I can't lose any longer if those are the only 2 contracts left in that position. With those 2, I start to shoot for the sky and really try to keep all those 86.25 that I just got for selling this contract in the first place. That's the first contract that I could be considering. Next one, you see another cluster setting up here around 2,700. So let's have a look at those. And I could be looking into selling this contract here for 92.25. But that doesn't make much sense to me, because I can sell pretty much a contract which is 20 more points here higher, 20 points easier for me for price to hit that strike price and get pretty much the same money. So, and also moving on to the next one here, 2,704. Let's just go for this one here. Do I get more money for taking on additional risk? No, I don't get more money for taking on additional risk. So I'm looking here at selling. Yeah, let's just go for this one here. Once again, I want to sell this market. How many contracts can I sell? How much risk am I willing to take? I'm willing to risk, again, $115. So I just dial this number up here. And you can see now, I can trade big here. I can trade 16 contracts for this risk and this maximum potential profit. Again, price has to move by quite a bit. The price has to settle at or below the strike price to give me that maximum payout. This is not what I will do. I will not be shooting for the stars here with everything. I'm just taking my 7.5 risk on that trade. And I have 16 contracts, a short position of 16 contracts. I have a well-defined position here. I'm just risking half of my 1%, my $115. So what's the risk per trade? $7.50. I'm willing to close 8 of those contracts if price dropped by 7.5 points. 92 minus 5. So let's say if price drops to 84, I'm happy to close 8 of those contracts. Scaling out, I have taken as much profit at that stage as I have risk on the table left. And this means I shouldn't be able to lose any further money on that trade, on that position. And now I have 8. If price really drops and price gives me and hits me, and I'm closing out half of my position, I have 8 contracts on, which didn't cost me a thing. And how I want to trade and manage those, if I want to do it conservatively and again go for scaling out a little bit more, a 2-to-1, 3-to-1, 4-to-1, or if I want to be aggressive and really shoot for the sky here, completely comes down to your style of trading. Guys, does this make sense how I approach this contract selection and the management? And also the nice thing is I am not being stopped out because I don't have any stop losses in place. What theoretically could happen is that the market tries to rally a little bit further within the next day or two, hitting me or filling me and giving me good, or at least nice results on my bullish trades. And if the market then starts to fall apart within the life cycle of that option, and for both things to happen, 3 days might be really, really courageous to go for. I don't think that this is likely, but theoretically, yes, it could give me all the profit targets on the bullish trades, and then the market could start to drop and even hit me and fill me on the bearish trades. A little bit advanced. Yeah, Guys, any questions? I wanted to also cover 2 more markets, but I feel that it was far better to spend the time here going into detail on this trade management and building the cases both for long trades and the short trades. And yeah, elaborating there a little bit on how this trade management moves us so far apart from this fire and forget approach, where you think it's just a gamble. No, it's a very powerful trading instrument that you can use to your advantage. You just have to dig in a little bit here and realize that the pricing of the binaries is dependent on the move of the underlying, but the move in the underlying doesn't have to give you a 3-to-1 or 4-to-1 or 5-to-1. The pricing of those binary contracts is what has to do that. If you're shooting for a contract here, which is really out of the money or here deep in the money, price has to travel a bit. But in that scenario, a move of just a few points in the binary is something which may totally happen. We don't know if it will. And for that reason, we have to be consistent with our position sizing. All right, market data. Thelman is bringing up a good point about market data. What we are seeing here is a proxy for the S&P 500. The price, I'm pretty sure that the price, and you can read all this up on the Nadex website on homepage, how the pricing mechanism of the underlying market actually works. Here, I'm pretty sure that the pricing for the US 500 is based on the E-minis. Unfortunately, here with the E-minis, currently I only do have delayed market data available for this market, for this webinar, and this is why I'm using here the proxy based on of the CFDs. So yes, there's a slight offset. Here you always do have the indicative price, and that's the true price being used. And guys, it's far from perfect, but again, it's here, it's available, and you can just have a look at the charts here. That are provided with, and you can just have a look here at, you want to see, for example, here an hourly chart and zoom out. Is it perfect? No, it isn't. Is it good enough to get you started and to truly reflect what is, which strike prices are available? Where is the market? Where's the underlying indicative market sitting here right now? And there works perfectly. Here, just on the hourly chart, pullback. Where does price pull back to? It pulls back to our moving average buy zone 10 and 20. Small bullish candle setting up here, and price pushes higher. We just discussed previously trading shorter expiry cycles, the daily, for example. Sure enough, if I'm looking at an hourly chart, here I wouldn't be going for the weekly option. Here I would be looking at something which 1 candle equals 1 hour. So I want this move to have room to breathe for maybe 3, 4, 5 more hours, and that would choose my expiry cycle selection and picking that up. Joao is asking about a recording of the webinar. Not really sure, but we are recording the session, and I'm not really being sure how it's being shared. Yes, it's being shared. I'm just getting the information here. So Joao, we've got you covered. No problem there. How did you get to that chart view? Easy as that. You just go here to your market section, and then second column, I'm using the default layout. Nothing really here that I wanted to change. In the charts, you have those 3 small bars making up that histogram, and you just click on that one, and the chart pops up. If you click down here in the lower section, you can customize that chart a little bit further, and this is how you can get there. Also, just getting information, everybody will get the recording. It will be sent out with an email just after the webinar, so no need to follow up on that. We've got you covered there. Yeah, guys, if you don't have any further questions, I would be now switching back to the finishing slide here. And yeah, for me, it comes down to thanking you very much for tuning in today's webinar. I hope you enjoyed today's session. You found it useful. You learned something new. Any feedback that you do have for us is really always greatly appreciated. And guys, thank you very much for the kind words. And Thomas is asking another good question. Thomas is asking, let me quickly go back, and those of you who already have to leave, you see how you can be in touch with Nadex here on that slide.